Let's Talk Money.
Hello and welcome to Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. The first ever mutual fund stress tests hit big headlines last week. And that's because this is a whole new paradigm for investors looking to invest in either mid-cap or small-cap funds. Now, these stress tests tell investors how quickly they can expect to get their money back in case of market volatility and in case there's a big fall and there are heavy redemptions. But it's not just liquidity. Mutual funds will also be making certain additional important disclosures which will give investors yet more data points that must be considered before making that investment call. But how do we assess all of these data points? How do we decide which is the right mid and small cap fund to be in? So to answer all of those questions that we've been getting, to take up your queries, we have with us on the show today Feroze Azeez, Deputy CEO at Anand, Rathi Private Wealth, and Mohit of Moneyfront. Thank you very much, gentlemen, for joining in. Mohit, great that you're here with me in the studio. And hello to Feroze on the wall over there. Feroze, good to have you join in digitally. And I must say that the last couple of days have been, I think, fairly stressful for the industry at large, for investors as well, because everyone's been trying to make sense of the first round of these stress test results. So I want to start by getting your opening thoughts, and then we'll straight away dive into the questions because, as you can imagine, we're getting plenty of them. So Mohit, first thoughts, are these stressful results?
Hi, Surabhi. Honestly, I think March any which ways is a month of stress, and there isn't any dearth of stress all across, whether be our industry or any other industry. But yes, I think the SEBI's measure is a step in good direction. However, how well the industry builds up from here will have to be seen from here on. But getting those additional disclosures, getting those additional data points, I think it always serves everyone well in the industry across the forum, right? Whether it's a retail investor, whether it's an HNI investor, or you and I discussing out here, any bit of additional data or information helps us assess the scheme, the nature of the scheme, the true to label characteristics of the scheme. And along with what you rightly mentioned, the ratios, the volatility ratios, the liquidity ratios and all those things, I think those are all very well taken steps. This kind of transparency was much needed in the industry, and I'm glad we have a lot coming out.
Absolutely. Well, the starting point, I'm sure you've already caught the headline, but if you haven't, one of the biggest new additional data points that we have today is that we will know the number of days that it's going to take any mid-cap or small-cap fund to liquidate, to sell down its holdings to the extent of 50% of the portfolio and 25% of the portfolio. Why should we know this? Because just in case there's a big market fall and fund managers have to meet redemption pressures, they need to sell down their holdings to give us our money back. We should know over how much time period can we get our money back. So Feroze, first thoughts again, because as a broad premise, this seems like a step in the right direction. But, do those number of days, does that disclosure really tell us the whole story?
Good afternoon, Surabhi. Like you said, of course, this is like Mohit also mentioned, it's a great step of extra disclosure. Point one. Does it tell the full story? The answer is no. Can the first step itself tell the full story? The answer is no again, because it will take some time to develop something. But it's a great step to give a number in terms of number of days to understand liquidity risk, because that's the most easily interpreted numerical integer from an investor standpoint. How long will it take for you to liquidate 50% of the portfolio? That's point two. So very good variable, layman-ish kind of variable. That's great. Now, third, the stress test actually is a pleasant surprise for me because if you look at the small cap space, 60 days is the highest, which is SBI small cap fund, 60 days being the highest to liquidate 50% of the portfolio. A portfolio built over 10-15 years of existence takes 60 days to liquidate. That's in your small cap space. I think I'm pleasantly surprised, whereas one fund says it will take me 13 days to liquidate as per the formula. To liquidate 50% of the portfolio. And we're speaking of small cap funds, mind you, and I'm very pleasantly surprised with the liquidity, with the assumptions, of course, that the volumes would go up 3 times. And Surabhi, I think you have completely dug deeper into this. I think I should ask for your interpretation, because I learned a couple of things in my interaction with you.
But it is your show, so it's all about your questions. So let me bring in my first viewer. We have Nitin Srivastava joining in. Nitin, hi, and welcome to Let's Talk Money. What's your question?
Hi, this is Nitin Srivastava. I'm working in a private company and also active in share market for some years. My query is why SEBI has targeted only small cap stocks, whereas the valuation is high across all segments, whether it is large, mid, small, or any. So, by naming only small cap, it is disturbing the whole sentiment there. Please guide me on this.
Mohit, your thoughts? Was this even needed? Does it really serve any purpose? And what the overall sense? I mean, there is a sense of trepidation, some hesitation now with mid caps and small caps in general. So, what do you say?
Surabhi, I am reminded of a very famous couplet out here कि हर दूसरे के पास अपने अपने मायने हैं एक दूजे के लिए नहीं but दूसरों के लिए आईने हैं.
Oh, okay.
So it was an industry which was cluttered with multiple thoughts. There wasn't a very uniform way of assessing the risk across the small and mid cap schemes, right?
Sure.
And why small and mid cap schemes? To be very honest, that's the segment which has seen massive run up last year, right? The small cap index per se was up almost 48%, mid cap index was up almost 44 odd percent, and the regulator and various other industry experts have highlighted the risk of a froth developing or a bubble kind of a scenario in the small and mid cap segment.
Yeah.
So I think SEBI has taken the right step. I understand that the valuations on the large cap front also would have soared, but when you compare it with small cap, the liquidity risk, which a retail investor is not aware of, is the highest amongst the small and the mid cap zone. So was it required? Yes, it was required. Additional disclosures are always more than welcome. However, how will it help? As you rightly said, you will have to club that information with the AUM of the scheme, with the market cap breakup of the scheme as to how well the scheme is running. Is it a true to label small cap scheme, right? So you will see a lot of small cap schemes running 85, 90, 95 odd percent small cap allocation. And perhaps that's the reason which is leading to higher number of days on the liquidity front. So you will have to club a lot of this information, and for a meaningful outcome to emerge out of this, you will have to put this entire sheet together, club the ratios, and perhaps this is a way of elimination and not a way of selection.
Fair enough. So, I want to get started with this exercise, and we will pull up some of the tables. What we've done is, for the sake of clarity for our viewers, we've divided this into two buckets, small cap funds and mid cap funds. So let's start with small cap funds because that's where the biggest hype is on risk, etc. And you can see on your screen there that, now, technically speaking, SBI's small cap fund is taking the maximum number of days to liquidate 50% of its portfolio, which is 60 days. Then comes the HDFC small cap fund. Then we have Tata. Now, Tata, by the way, the size is a lot smaller. The SBI small cap fund is over 25,000 crores. The Tata small cap fund is not nearly as big in terms of size, but as you can see, it's still taking about 33 odd days. So Feroze, come in on this, because here we have to marry the number of days with the size of the fund as well, right? Because typically bigger the fund, the longer it'll take to liquidate. So how do we sort of arrive at a consensus of what really is risky and what is only the nature of the fund? Because it's a big fund, it'll take longer to sell.
Great. So one, like you rightly said, there is something which is logically making sense that a bigger fund should take longer to sell under the same assumptions. And if you're giving 10% of the total volume of that day for that fund, then of course the bigger ones, like you rightly pointed out, Tata, for example, is eye-popping, right? It's a small fund and it takes the third largest time to liquidate 50% of their portfolio. So now how do you dig deep? Now, if you look at it, if you look at the weighted average free float of the stocks which are there in Tata is about 49%, which is one of the lower ones. Second, it has 10 stocks less than 3,000 crore market cap. Which is far too many with respect to the relative comparison with the rest of them. So they have even 3,000 crore market cap stocks, which might have a free float of even 800,000 crores in their portfolio, and 10 of those. Only 4% of their portfolio is an F&O exposure, by which I mean 96% of the stocks or weightage of the stocks which they own is not there in F&O. So like you said, Surabhi, the headline number tells you where is more investigation needed. And like you rightly spotted, Tata needed investigation. That's why I'm throwing up those numbers of free float, F&O exposure, and less than 3,000 crore market cap companies, which are a part of the portfolio to the extent of 10 of them being a part.
Okay, that's important. So a lot more other parameters just beyond the size that go in determining why a fund could be taking more time to sell down its holdings. Mohit, just very quickly before we take a break, your thoughts on this, because there's this absolute number that we get, number of days. But like Feroze mentioned, there are other factors. How many stocks are in F&O? What is the free float, etc. And then come in on the market cap mix as well, right? Because now we'll know that even if it's a small cap fund, whether it is 80% small cap or whether it's 65% small cap. So how do we interpret this? Because in a bull market, small cap funds, which have a lot of good small caps, they'll always outperform. But now we are being told that small cap funds with some large caps are actually safer. Very confusing for the investor.
Okay, look, so my thought is point number one, 20% of the most illiquid stocks are already out of the computation, right? So one part is whether if you have a portfolio which is extremely small cap in nature or illiquid in nature, where the free float is very little, right? That portion is already eliminated. The test is being done on the 80% of the portfolio, the balance portfolio. Now, when you club that, and in a way, even the AUM is accounted for, right? So even the AUM is accounted for in the parameters of the test. But the key criteria to my mind out here is to look at the market cap breakup. Just taking case in point, which is Tata again, Tata and DSP. If you check these two schemes, they are pretty smaller in size in the terms of the AUM which they hold. However, the small cap composition in Tata is almost 94 odd %, and even in DSP is almost 88, 90 odd % somewhere. Even for SBI small cap, the small cap component is very high. Contrast that with Quant. Right, the small cap component minimum has to be 65%, but if you see the other part, it's predominantly large cap.
And it's easier to sell those large caps, easier to get liquidity.
Absolutely. So the moment you move away from the true characteristics of this the scheme, right? When you're running a small cap scheme, I think an investor has to be extremely aware and cognizant what kind of a scheme he's going for. Whether if he wants a true to label small cap, mid cap scheme, then he has to compromise some inches on liquidity. You cannot have the best of all worlds, and perhaps you will have to then work around with this equation and figure out the best combination which suits your appetite.
Fair enough. What we'll do is we will illustrate this with an example, because after the break we have some more viewer questions and some of the viewers are asking about specific funds. So let's take up one or two of these funds as examples and see how we need to apply some of these new data points that we've got, and then come to a conclusion whether it's a good fund or not such a great fund. Quick break. We'll be back in just a moment.
Let's talk money.
Welcome back. Here with us on Let's Talk Money, and this time we are simplifying, trying to decode what these mutual fund stress tests really mean and whether you need to do anything different with respect to your mid-cap and small-cap funds. So we have a question coming in from Deepak. Let's see what Deepak wants to know. Deepak is saying that he has significant exposure in the HDFC Mid-Cap Opportunities Fund and is asking what the stress test results signify for this particular fund. Okay, so the fund in question is the HDFC Mid-Cap Opportunities. I'll quickly talk about the data points that we now have for this fund. Well, let's start with the basics. The fund size, it's a large size fund, over 60,100 crores of assets under management. What have the stress tests revealed? The stress tests tell us that it will take 23 days to liquidate 50% of this fund's portfolio and 12 days to liquidate 25% of the portfolio. Now, the additional data points also tell us about client concentration or investor concentration. So, if you look at the top 10 investors of HDFC Midcap Fund, how much of the fund do they actually hold? Well, they hold about 1.4% of the total fund size. And then we have what is another critical disclosure that's coming through, which is the market cap mix. This is a mid-cap fund, but does it hold all mid-caps or some mid-caps, large caps, etc.? So, it's in front of you. The mid-cap share is about 66%. The large cap share in this fund is about 13%. The small cap share is about 14.5%, and it's sitting on about 7% cash. So we have all this data. But gentlemen, data is one thing. Interpreting the data and making sense of it is another. So Feroze, let me toss it to you. Now, we have all this new data that as an investor I'm aware of. How should I make sense of it for the HDFC Midcap Fund?
Yes, so I think if you look at the data points which are newly there, I think those data points don't show anything alarming. So Deepak does not have to take action on this fund on the new data points which have emerged. Point one. If you look at 23 days and 12 days, in isolation, they will not be such meaningful numbers. If you look at it relatively of how that fares vis-a-vis the rest of them, it'll become a more meaningful number. Any number gets meaning with the context you draw up around it. Having said which, so I think 23 and 12 days is something which I think is very, very good for a 61,000 crore, 60,000 plus odd crore and the largest mid-cap scheme. Second, I think the liquidity has also been kept in mind. Chirag Setalvad is a great fund manager, a fund which has been created in 20 years, practically, if I remember right, has the top 10 holders of the fund have 1.4% of 60,000 crores, which is about 700-800 crores. So the top 10 investors of the fund have 80 crore rupees as one specific individual or a corporate. So that's not too much of a concentration. That's because of the nature of the fund's existence of long periods of time. So Deepak, nothing to worry. If you look at the data with respect to liquidation is great in terms of liquidity risk being low. Point one. Point two, from a liquidity perspective, having 12% in large cap is a great prudent strategy. In spite of that, beating benchmarks over long periods of time where mid caps outperform large caps, especially in the broader market rally we have seen. Chirag has been able to outperform by still having 12-13% in large cap, so that's great. Third, I think the fund size is great. There's not too much concentration across top 10 investors. Those 10 guys can decide to liquidate and 10,000 crores goes away. It is just 800 crores top 10 investors. So I would say nothing to worry. Great data, better than I would expect the largest fund to throw up.
Okay, awesome. And see, this reminds me, viewers, please remember, see, when we spoke about this fund, how I didn't start with 1 year return, 3 year return, and 5 year return. I started with a lot of the other data points that we typically don't consider. And Mohit, I think that's the whole point of this exercise, to get people to think more laterally than just be return oriented. So HDFC mid-cap opportunities, what's your take?
Look, I think 60,000 odd crores, it's the largest fund in the mid-cap segment, controls 20% of the AUM of the entire segment, Surabhi, right? So Chirag Setalvad managing that size is a phenomenal job. And the way he has conducted the fund, absolutely no red flags in the data. I think you've rightly pointed out the lens of judging has kind of changed. The needle has moved towards risk parameters and other parameters. If you see at the turnover ratio, it's 19%, right? So for a mid-cap fund of that size, shows the kind of conviction a fund manager is running. The turnover ratio is fairly low. You look at the P ratio, right? And all those matrices are now published. The P ratio of the fund is lower than the benchmark P ratio, which is again a great sign. Running a fund of that size and not overshooting on the valuations or on the kind of stocks, the stock picking ability of the fund manager, it speaks volumes about that, right? And obviously the breakup of market cap, which is again fantastic, 65%, which is mandatory in mid cap, small portion in small cap, which can give him the desired alpha, and large cap obviously to provide stability and liquidity and the kind of redemptions if someday some redemption pressure were to arise. But even on the liquidity days, right, the fund is extremely well poised for that kind of size. 23 days, I think it's fantastic. So I think it's a great fund.
So it's a thumbs up from both our guests. I'll quickly squeeze in a question that's coming in from Pritika. Pritika is on the phone with us. Pritika, hi. Tell us, how can we help you?
Hi, I'm Pritika. I am a media professional based in Delhi. Last couple of years, I'm investing in small caps and mid cap funds like Nippon and Edelweiss, and it has given me a very high return. Keeping the present situation in mind, should I take out the money and invest in large cap, or should I remain invested?
Okay, Pritika, thanks very much. Now, I'm just tossing this to both our guests. You'll have to do this with your financial advisor independently. But, let me ask, Mohit, the Nippon fund and the Edelweiss fund, any thoughts on these two?
Look, I think Nippon, I'm assuming we're talking of the Nippon small cap and the Edelweiss mid cap, or vice versa?
The Edelweiss small cap and the Nippon mid cap.
Edelweiss small cap and the Nippon mid cap. So Nippon mid cap is the erstwhile Nippon, the Reliance growth fund, right? Again, almost 2-3 decades of performance. It's been again a fantastic fund from that perspective. From the liquidity ratio perspectives, I don't think so both of the funds have any causes of concern out there. right? Even in terms of the market cap breakup, if you were to see, Nippon perhaps has a little, the Edelweiss small cap has a little lesser on the small cap side, but again, I don't see that as a major reason or cause of concern on any of the fronts. So from my side, both the funds have done reasonably well. Performance-wise, they are good. On all the other parameters also, they are good. But I think the larger part of a question is whether she wants to shift from mid and small cap right now and move into some other segment or large caps. Right? To my sense, that is a very individual specific thing. Depends completely on the individual's asset allocation and risk profile.
Sure.
If you have overshot because of the market rally on the mid and small cap segments, then by all means, yes, cut down, trim down your exposures and move to large caps, be a little safer, right? But if you're well within your asset allocation framework and if you're well within the mid and small cap stipulated for your portfolio, then
Sure.
I think one should continue and hold these.
Fair enough, fair enough. Now, Feroze, as we're coming to last thoughts, of course, people will do their own homework, but is there an overarching call that you'd want to put out on any one or few funds, mid caps or small caps, where action is warranted because of this additional information that we have now, thanks to the stress results?
See, I think if you look at in the small cap space, we in our model portfolio exited one of the schemes, which is Birla Small Cap. We've done enough data analytics to come to that conclusion because we don't take model portfolio calls without enough data analytics. That's point one. So that's one exit. If you have it, I'm sure you can switch to other small cap funds. The two small cap funds you can continue to buy. Invesco India Small Cap Fund and HDFC Small Cap Fund. I don't think the small cap rally is over as yet. Of course, Nifty plus 3% kind of alpha possible from year on for a year. I think that should not be missed out. So as long as you have 20% or lower in small cap on an overall portfolio, you're good. If your mid cap is not more than 20-25% on your overall portfolio, that's great. Unlike investors who buy core small cap funds and 80% of it in small cap is what's the worry. So Invesco and HDFC a buy, Birla Small Cap a sell is the sharp recommendation I would like to lay out.
Okay, Mohit, very quickly, 10 seconds left. Any specific fund action that you'd recommend?
Look, for
buy
me,
or sell?
For me, this is more an elimination criteria, and I will lay out that. First reason for eliminating a fund will be high turnover ratio. I'll quickly eliminate all those having a high turnover over 1, which is 100% of the portfolio in a year. Then I will try and eliminate funds which are running extremely high PE ratio because I think valuations have any which way soared up. So there's no point for me continuing there. And to me, on the small cap segment, after putting all the filters, I still like DSP and Tata small cap funds, right? Because they are running a pure true to label strategy, and which is what I like in that segment.
Okay, so if you have the risk appetite, then you can be with true to label small cap and mid cap funds. Gentlemen, we're completely out of time, but thank you very much for joining in and answering all of these viewer questions. I'm sure we'll keep getting more and we'll call you right back for it. But for now, it's a quick wrap on this week's episode of Let's Talk Money. We hope to see you again with more questions and queries next week.
Let's Talk Money